Hey, do you want to start investing but you get intimidated with stocks, ratios, and principles? If the answer is yes, this is a perfect place to start our journey together. Welcome to our investing mini-series, Stock Market 101, which is meant to help each and every one of you to take first steps in investing with understanding and clarity. The examples are going to be presented based on the book Why Does the Stock Market Go Up by Brian Feroldi, who, by the way, has been our guest before. Let's get started. Part 1. Basics of stock market. What is a corporation? A corporation is a legal entity that is separate from its owners. Corporations are owned by shareholders. The shareholders have a legal claim on the corporation's assets and profits, but are not personally liable for the company's debts or actions. It means that corporations make it easy for businesses to raise money from investors, and they also offer legal protection to the investors in case business gets sued or goes bankrupt. What is a stock? A very common way for a corporation to raise money is selling stock, which is also called equity or shares. Owning stock means that you own a piece of a real business. You become an owner of a real company who hires people, produces goods, or delivers services. A business that expands and grows. A stock or equity is a financial security that represents the ownership of a fraction of a corporation. What it means is that the shareholders have a claim on a portion of the company's assets and profits. Shareholders also get to vote on how the business is managed. And stocks are a simple tool for investors to identify how much of the corporation they own. In order to find it out, the shareholders divide the number of shares that they own by the total number of shares. Now, let's make up a business called Best Coffee Shop, owned by Natalie, Ethan, and Lauren. They decide to turn it into a corporation and sell stock in the new business for $1 per share. Let's say that Natalie contributed 60% of the funding and owns 60% equity in the company. If there are 10,000 shares, she owns 6,000 of them. Ethan contributed 30% of the funding. He owns 30% equity in the company and 3,000 shares. Lauren contributed 10%, therefore she owns 10% of equity in the company and 1,000 shares. Why do stocks have value? If a company is successful and makes profit, the owners of the business equity can claim the profit and pay it out as dividends. Imagine that Best Coffee Shop is successful and it makes $5,000 in profit during its first year. Natalie, Ethan, and Lauren make a decision to pay the $5,000 in earnings to themselves. They would be paying themselves a dividend, which is a portion of the company's profit. Since each of the owners own a different percentage of the company's equity, in order to find out how much of that $5,000 should go to each of them, we need to divide the total dividend payment by the total number of shares. This means that Natalie would receive a $3,000 payment, Ethan would receive a $1,500 payment, and Lauren would receive a $500 payment. Just think about the fact that Best Coffee Shop made $5,000 in profit after 1 year, and it pays out 50 cents per share of stock they own in dividends. Does it make you interested in owning a portion of that company? Probably yes, and it means that the shares have value. When you own shares, you have a legal claim on a piece of company's assets and profit. If the company makes money, that money belongs to the shareholders. But not always profit is paid out to shareholders in the form of dividends. It's very common for the company's management to keep the profit within the company and use it to pay off debt, buy equipment, or invest in hiring new employees. What is the stock market? A stock market is a place where businesses and investors can connect with others to buy and sell stocks. You simply trade your money for shares of the business. Publicly held businesses enter the stock market by issuing shares, which later on are being exchanged between investors. The largest stock market in the world was founded in 1972 in New York City at the very famous Wall Street, which is called the New York Stock Exchange. Some other world-renowned stock markets to mention are Hong Kong Stock Exchange, London Stock Exchange, Tokyo Stock Exchange, or Nasdaq. Now, let's look at some of the common stock market indexes. An index is a group of stocks that are combined to figure out whether the stock market as a whole is going up or down, which helps tracking the performance of the stock market. Dow Jones Industrial Average. It is a stock market index invented by Charles Dow and Edward Jones in 1896. The idea was to add up the share price of 12 of the most popular and biggest publicly traded companies at the time. Then the total amount was divided by 12. The result was supposed to be a proxy for what was going on with the stock market that day. In 1928, the Dow Jones expanded to include 30 companies, and every couple of years, some of the declining companies are removed and replaced by businesses which are growing and becoming popular. Dow Jones is a price-weighted index, which means that each stock is weighted by the current share price. Stocks with higher share price have more influence over the index than stocks with a lower share price. The dollar price of each stock is what matters, not the actual size of the business. S&P 500. Standard Statistics Company created a new stock market index in 1923, but then merged with Poor's Publishing to create the Standard & Poor's S&P Company, thus S&P 500. In 1957, it was already competing with Dow Jones by increasing the number of tracked companies from 233 to 500. Then, S&P 500 enabled larger businesses to have more influence over indexes movement than smaller businesses. S&P 500 would judge the size of each business by using its market capitalization, meaning the total dollar market value of a company's equity. To find market capitalization, you need to multiply the total number of a company's shares by the current market price of one share. S&P 500 is a capitalization-weighted index, meaning that each stock is weighted by its current market capitalization. So bigger companies have more influence over the small ones. Nasdaq. National Association of Securities Dealers Automated Quotations was a brand new stock exchange created in 1971, which allowed investors to buy and sell stocks on computers that were connected to each other. It provided many advantages over other stock exchanges, since all the buying and selling was completed on computers, with accurate prices being visible and accessible for all investors in real time. The Nasdaq Stock Exchange also created an index that tracked the price movements of all companies that were listed on the exchange, which was called Nasdaq Composite Index. Nasdaq Composite Index is a capitalization-weighted index, just like S&P 500. Meaning that larger companies have a bigger influence over the movement of the Nasdaq Composite Index than smaller companies. This is it for today's lesson. If you enjoyed this video, leave a comment below, like and subscribe to our channel. Don't forget to ring the bell for notifications and watch our next videos. There are more reasons for companies to go public and sell their stock. These include raising money to expand, grow, invest and pay off debt, existing owners selling their stock, and making buzz and becoming more visible, getting attention from media, potential investors, and new customers.